What is up, everybody? Shaun here, and in this video I want to go over what I consider to be the single greatest investment that you can make if you want something that requires no time, zero skill, and will allow you to beat out 99% of individual stock pickers, or also 95% of hedge fund managers over a 10 to 15 plus year period of time. And that investing strategy is index funds. I'm going to explain what index funds are, what makes index funds such an effective strategy, and why they will allow you to outperform 99% of stock pickers. We're also going to discuss what the best index funds are out there and their performance over the last 10 years, an investing portfolio strategy that will help you beat out that 99% of stock pickers or investors. And lastly, if you stick to the very end, I'm going to discuss an allocation strategy based on your age to create the ultimate investing environment and setup to really maximize those profits. If you are looking to become a multi-millionaire in your lifetime, this is going to be an investing strategy that you should look into. So if that sounds awesome to you, go ahead and smash the like button, hit the subscribe button, the notification bell. And if you haven't done so already, or this is your first time after this video, be sure to check out some of my other videos. I'll leave a link below to one of my most popular videos, The Smartest Route to $10,000 a Month this year, where I walk you through step-by-step how to go from $0 to $10,000 a month, creating a service-based business. It's the exact step-by-step strategy that I did to allow myself to go from $0 to that six-figure $10,000 a month mark within my very first year. I'll leave a link below in the description box. So this brings us to the very first question, which is, what is an index fund? For those of you who do not know, an index fund is essentially a collection or portfolio of individual stocks. Instead of going out and buying a bunch of individual stocks, you can invest in one simple fund that comprises a bunch of individual stocks itself. Another way of looking at it is, instead of going out and just buying one individual property, you could put 1/10 of your money into 10 different properties. The reason this is so advantageous is because if you only own one single family property, if for some reason something happens to that property, a tenant doesn't pay rent, or you're unable to get the place rented out a particular month, you're gonna make a zero profit for that particular month. However, if I have my money invested across 10 different properties, even if one property doesn't collect rent that month, odds are the other 9 will, and that will still give me a collective average of how everything is doing as a whole. And this is essentially all an index fund is. Instead of going and buying individual stocks, you are buying a portfolio of stocks and getting the collective average performance of all the companies that are within those portfolios. Now, these indexes can range anywhere from a couple hundred companies all the way to many thousands of companies. And they can also range in all different types of industries and sectors. So if I want to own the 500 largest publicly traded companies, I could buy the S&P 500. If I wanted to own all the publicly traded companies in the US, I could buy the total market index. There are also indexes for real estate. There's also indexes for tech, healthcare. There are indexes for all different types of companies, industries, and sectors. So this brings us to the question, why invest in index funds? Well, in my opinion, there are 4 major reasons that make index funds perform so much better than individual stock pickers out there. The very first one being is that they just perform better overall. Studies have shown that over a 10 to 15 year period of time, professional fund managers are unable to beat index funds anywhere between 92 to almost 97% of the time. Now keep in mind that fund professionals are some of the smartest, brightest, most talented people in their field. These are people who went to Ivy League colleges, and if they are losing out 92 to 97% of the time, then that means for the average person like you and I, that statistic becomes even worse. And in fact, it's shown upwards of 99% of the individual stock picker is probably going to lose out to an index fund over a 10 to 15 plus year period. And if that's not enough, maybe this example will give you an idea. Warren Buffett, who is one of the greatest investors of all time, had a $1 million bet with a hedge fund agency. And he said that over a 10-year period, he was going to take a $500,000 and invest it in an S&P 500 index fund. And he challenged any hedge fund manager to beat him using whatever buying and selling strategy that they wanted. Now, a company named Protege took him up on that bet, and they went ahead and invested in some of the biggest hedge funds out there. Well, over the course of that 10-year period, not only did Warren Buffett beat the hedge fund managers, but he completely demolished them. Over the next 10 years, Warren Buffett averaged a 7.1% return, or in other words, turned it into $854,000. Whereas the hedge fund managers we're only able to generate a 2.2% average, somewhere around $220,000. One of the main reasons for that actually brings us to the second point of why index funds are so powerful, which is the fact that index funds have very low fees associated to them. On average, index funds typically are only going to be 0.03 to 0.04% expense ratio, also known as the amount of fees you'll be paying out to have the fund passively managed in an index fund. When you compare that to an actively managed fund like a mutual fund that has a professional trader buying and selling on your behalf, you're going to see an average about 1.34%. However, that doesn't even include the fact that a lot of mutual funds have what's called invisible fees. And these are fees they do not have to report, but they do come out of investors' pockets. The recent studies show that the additional hidden fees can go all the way up to an additional 1.44%, bringing the total expense of the average actively managed mutual fund being close to 2.8% total. Now you might be thinking, well, 2.8% doesn't really sound like that much in general compared to 0.03%. You have to keep in mind that for every 1% that you pay in fees, you could be losing upwards of 20% in potential lost profits had you been able to keep those fees in your pocket and reinvest it back into your actual investment. And so when you're talking 3% in fees, you could be losing upwards of 60% lost profits over a 20 to 30 plus year period of investing. And this is why fees become such an important component to your investing strategy. The third thing that makes index funds so powerful in terms of becoming a multimillionaire is the fact of diversification. In general, the more diversified you are in your investing strategy, the less likely you are to lose a lot of money. And in fact, Warren Buffett always says that the number one rule to investing is don't lose money, and the second rule is refer to rule number one. While you might be one of the lucky few who invests in a company that skyrockets over time, you might also be one of those people who invests in a company that tanks 90% over the last year or two, essentially losing almost all of your money. And so if all of your money is placed in one individual company, if that company does not perform well due to whatever reason, all your money is going to go along with it. If I have 100 companies, I'd only lose 1/100th of my money. And so the more companies that you're spread out amongst, the less likely you are to see any significant downturn. So in general, the more diversified you are, the less likely you are to take a hit on a loss of money. And that's because if one company doesn't do well, you have a lot of other companies that probably are performing well that's giving you a better average. The last reason why index funds are so powerful is because they're so easy to do. Investing in index funds is very much a set it and forget it strategy. You don't have to worry about researching stocks. You don't have to worry about researching companies or economic changes. You don't have to worry about all these different policies in place and how it might affect your particular company. All you're doing is investing in an entire index and getting an average of how the index is performing. It literally will take you 15 to 20 minutes to set up an account, and then you might spend 1 hour a year overlooking your portfolio and seeing how you're doing overall. Instead of worrying about trying to be one of the very statistical few that can beat the overall average, you can just play the average and then spend your time working on making more money and using that additional money to invest back in. And that really is one of the most best tried and true methods of building exceptional wealth over time. Now that we know what index funds are and why they are so effective, the next strategy is how do you actually invest in these index funds and what is the best portfolio setup to ensure that you beat out 99% of those individual stock pickers. One of my absolute favorite strategies is what's called the 3-fund portfolio. This strategy gives you the broadest diversification over many different sectors and industries. Now, the 3-fund portfolio is comprised of 3 funds, and those 3 funds consist of US stocks, international stocks, and bonds. Now be sure to stick to the very end of this video because I am going to describe how you can set up the proportions of these based on your age to give you the best investing environment. So let's start with the very first component, which is US-based stocks. There are all kinds of index funds that you can invest in for US-based stocks. However, in my opinion, there are 3 main ones that you should look at. The very first one is probably the most popular one, and that is the S&P 500. And the S&P 500 is the 500 largest publicly traded companies. And so when you invest in this, you're essentially investing in the 500 largest companies. You're going to see companies like Amazon, Nvidia, Tesla, Facebook, Google, Verizon, and Best Buy, and so on and so forth. And over the last 10 years, the S&P 500 has averaged around 11.87%. Now, for those of you who want to have even broader diversification other than the top 500 companies, then I would be looking at the total market index. The total market index not only comprises the 500 largest companies, or in other words, large cap companies, but they also comprise small and mid cap. So in other words, if you're investing in the total market index, you're investing in every single publicly traded company, no matter how small or how big. And over the last 10 years, it has averaged around 11.22%. Now, for those of you who want to get a little more on the aggressive side and have the highest upside potential in US stocks, I would be looking at the QQQ. This is the top 100 emerging companies in the tech sector, and this has averaged over 17% in the last 10 years alone. Now, keep in mind when it comes to index funds that the more aggressive it is, the more likely you are to experience volatility. So this brings us to the next category, which is the international stocks. Instead of just investing in just the US stock economy, you're also investing in all the international stock economies, because if the US economy does not perform well, perhaps other economies will. The two most popular funds are the Total World Stock Index, which over the last 10 years has averaged around a 7.79% return, or you have the Total International Stock Index, which has a 10-year average of 3.6%. And finally, when it comes to the bond fund, you're looking at the Total Market Bond Fund, which has a 10-year historical average of 1.11%. Now, this brings us to the question is, how do you organize these funds in a way to really maximize returns? As a general rule of thumb, the further away you are from retirement, the more aggressive you can be, meaning that you'd go a lot heavier in the US-based stocks or the international stocks, and you'd go lighter on the bonds. If you're in your 20s, 30s, maybe even 40s, this might be more of your strategy. However, if you're getting really close to retirement and you can't afford to have a temporary dip in your overall stock investments, then you may want to go heavier in bonds and go lighter in things like stocks. One of my favorite investing strategies for the 3-fund portfolio is the 80-20 rule. If you are someone who is younger or wants to go a little bit more aggressive with overall growth, then you want to have 80% stocks and 20% bonds. Of those 80% of stocks, you might go closer to 64% in US-based stocks and 16% in overall international stocks, leaving you with 20% remaining in bonds. Now, for those of you who want to go more moderate in your investing, you may want to do an equal weight between US-based stocks, international stocks, and bonds, between 33 to 34% in each one of those categories. And if you're getting closer to retirement, you may want to look more towards the 20-80 ratio, 20% stocks, 80% in bonds. So in this strategy, you might do closer to 14% US-based stocks and 6% in international stocks, with the remaining 80% going to bonds. Now, I want to conclude the video with overall market timing, because a lot of people are asking the question, is this the right time to buy? A lot of people are anticipating a potential recession. Are we out of it? Are we going to go back in one? Has it actually really started yet? And so a lot of people are asking, should I wait? Should I buy now? What I can tell you is that no single person can truly know what's going to happen with the overall economy. Take just a few years ago with the pandemic. So many people were saying that that was the end of the bull run. It's over. We're going to hit a long period recession because we've been in the longest historic bull run of all time. But yet those very same people, just a few months later, when the market pretty much fully corrected and was back to normal, were saying, wait, no, we were a recession. No, never mind.